Hey, how's it going, everyone? And welcome to Dividend Compounders with Cheese. I wanted to try something a little differently and talk about the stocks that you want to put on your radar for this upcoming week. What you see on your screen right now are all the different companies that are going to be posting their earnings for the week of February the 12th. Now, as we kick things off on Monday, nothing too exciting is reporting before the market opens. However, as the market closes, the one company that I am keeping my eye on is going to be Waste Management, which is a trash utility company. Believe it or not, the trash companies and stocks have just been amazing dividend compounders with cheese. Case in point, let me show you. Just look at the 1-year performance of Waste Management. Roughly $150, and up to now, that has been a 24.5% return. That is simply amazing. And I don't know why it's saying there's a zero dividend yield. They actually do pay a dividend. So Waste Management currently has a 1.4% dividend yield, which is a 50% payout ratio. The dividend growth rate is roughly 7%. I actually really like Waste Management, but better than them is Republic Services. And if I ever see the trash stocks go on discount, I am jumping in. However, right now at this valuation, there's better opportunities in the market. And as dividend investors, there's nothing else really important to note for Monday. However, the next day for Tuesday before the markets open, there's a lot of big names that are going to be posting their earnings. The biggest one that I can see is Coca-Cola. This is a dividend darling. Everybody likes them. Personally, I prefer Keurig Dr. Pepper over Coca-Cola, but I still appreciate Coca-Cola. So let's just see how they do on Tuesday. I think they're going to beat earnings or at least match the estimates. And then next up is going to be Krispy Kreme, ticker symbol donut, which is amazing, which I don't know if it's just me or not. For the past 5 years or so, whenever I visited Krispy Kreme, it just seems like the size of the donuts have been getting smaller and smaller to the point where it's almost the size of my nipples. But and then of course we have Marriott International, which has a portfolio of a bunch of hotel chains. I'm not really interested in that type of investment. And then we have Restaurant Brands International, which is actually the parent company of Popeyes, Tim Hortons, Burger King, and most recently they acquired Firehouse Subs. If you've ever been to a Burger King recently, then you notice that the prices for their burgers are just not matching up to what you get. I'm not a fan of Burger King. Same with Popeyes. And then there's TAP, which is one of the biggest alcoholic beverage companies in the US. And then, of course, there's Hasbro. This is a company that has been on my watch list for about 4 or so years. And Hasbro is the parent company for a whole bunch of toys, card games, and board games that actually pays a juicy dividend. And it's one of the first companies that we did a deep dive on during my MBA. Like, this is the stock that they used to teach us how to analyze a balance sheet. So I kind of understand the company. In the past year or so, I removed them from my watch list because they are making some questionable decisions as to their future and their Magic the Gathering card series. So as of right now, I'm just going to be monitoring Hasbro from a distance. And also on Tuesday before the markets open is going to be Moody's. Moody's is also one of those credit rating bureaus that certain YouTubers really like. And as of last week, SPGI, which is S&P Global, they reported their earnings and they actually missed their EPS estimates. And so that stock got obliterated. They were down like -8% at one point, and they closed the day at being -5%. Moody's and S&P Global, which are the credit rating bureaus, they usually perform about the same, and the market has very high expectations for them. Case in point, I'm going to show you the trading multiple for Moody's. So Moody's right now trades for about $398 per share, and the PE ratio is 48, which means the market has very high expectations for Moody's and also for SPGI. So if they slip up at all, it's not going to be unusual to see the market punish them -5%, -8%, -15% on one trading day. And last but not least, on Tuesday, I am watching Ecolab, which is ticker symbol ECL. Now, Ecolab is in the business of making sanitizing products and cleaning products, which I actually like the company and the stock. However, their valuation has been a little crazy, so I consequently removed them from my watch list. However, every quarterly earnings report, I do keep my eye on Ecolab because if they go on a dip, that could be an opportunity for me to finally buy in. Right now, Ecolab has a trading multiple of 47.16. And I can't tell the future, but they're more than likely going to beat or match the estimates that they laid out with Wall Street. So I probably won't be able to buy in. And then after the markets close on Tuesday, for dividend investors, there's nothing really important for us to look at. However, if you are interested in growth stocks, I think the ones that you want to keep a close eye on is Airbnb, Lyft, and Zillow. The reason why you want to look at Lyft is because Uber just posted their earnings this past week and they crushed it. So their stock has just been sailing. However, Lyft, on the other hand, which is in the exact same business as Uber, has been depressed for the past 52 weeks. So this could be an opportunity for them to surprise Wall Street and actually beat the estimations. And then as we move on to Wednesday, which is going to be Valentine's Day, happy Valentine's Day, everyone. The companies that you want to be keeping an eye on before the markets open is going to be Kraft Heinz. They're most famous for their deli products and ketchup. And then, of course, Owens Corning. They make a lot of products and supplies that go into the house building process. So their earnings report is usually indicative of how the housing market is doing in terms of, are we building enough houses to meet the demands of the American public? So this company is an indirect play on the housing market. However, for traditional dividend investors, you're probably going to be eyeballing Kraft Heinz. When Warren Buffett went balls deep into Kraft Heinz, I was kind of like, what? Why? However, I get it. Their PE ratio is about 15 and they have a dividend yield of 4.4%. And the stock is cheap itself, right? It's $36. So I see the appeal, but personally for me, not interested. And as the markets close on Wednesday, I think there's two companies that I'm personally interested in. And that's going to be Cisco, which is one of the more grandfather technology companies, which is responsible for a lot of the IT infrastructure products and security systems for a lot of company laptops. So I'm going to be looking at Cisco because they actually do have a juicy dividend yield, and I think their stock has been beaten up for the past 52 weeks. So if they miss their earnings, I'm probably going to pull the trigger unless they miss their earnings because of a huge, dangerous, scary reason. Then I'm going to avoid them. But if they miss their earnings estimates by like 1% and the stock market punishes them by like 5 to 10%, yeah, I'm going in. And then the next one is, of course, American Water, ticker symbol AWK. Some people believe that the next big lucrative industry is going to be the water utilities and wastewater management because there's only a finite source of water around the world that's drinkable. So that's their investing thesis, and they go all in on American Water and a couple other water stocks. It's there if you're interested. On Thursday, before the markets open, there's Crocs. Did you know that Crocs is actually severely undervalued in this very expensive market? And that's because Wall Street believes that their momentum and their popularity cannot sustain itself. However, if you ever look at the feet of anybody under the age of 30, depending on the context, of course, more than likely they're going to be wearing a pair of Crocs. It seems like everybody is wearing Crocs or Hey Dudes. So this is a company that I would be interested in. Unfortunately, they do not pay a dividend. So moving down this list, a company that does pay a dividend and is absolutely crushed is Wendy's. And if McDonald's is anything of an indicator of how the fast food restaurants are doing, my prediction is Wendy's is probably going to miss as well. Because if McDonald's missed their estimations, what makes you think that Wendy's is going to beat it? Right? And then, of course, there's Hanes. Hanes is a company that has just been absolutely beaten up for a long, long time. And this is a company that I actually was interested in as joining as a product manager at one point. And then I realized the future of Hanes is not aligned with what I want to do. But they do have one brand in their portfolio that is just kicking butt right now. And back in the day, like 20 years ago, people used to tease whoever wore this brand because it was considered a budget apparel. And that's Champion. However, now their story has turned around and everybody is wearing Champion and it's considered a premium good. And then, of course, under them is Severn Company, which is a utility company. And by the way, if you're looking for an industry that is undervalued for the current time being, it's the utilities. Every single utility company just seems to be at their 52-week low. And then, of course, there's Oatly, which I just don't understand how they're still publicly traded. If you've ever sipped on milk alternative alternative drinks before, then you realize that they're terrible, they're disgusting, and they taste like a bag of farts. So I don't see why and how they're sustaining themselves, but I know that the vegan movement is growing and there's people that want to drink milk, but they can't, so they buy products like Oatly. However, for me, I'm a huge fan of Fairlife, which is manufactured by this company right here, Coca-Cola. They make real milk products that are ultra filtered to be double the percentage of protein, and I love that as a meathead. And then as the markets close on Thursday, I'm not really seeing anything that's too important except, right here, Digital Realty. So this is a REIT that specializes in data centers. And Digital Realty is a company that I'm kind of interested in because they have a business that I see will be thriving in the next 10 to 20 years. Anyways, this is a list of companies that use the services of Digital Realty in order to utilize their data centers. They have Cisco, AT&T, a Japanese company called Fujitsu. So there's 227 companies that are utilizing Digital Realty's data centers. And when you break that down, 44 of them are in the IT business, 21 are construction companies, 16 real estate, and the list goes on and on and on. But I think this is a very smart investment for the future. However, when we look at their valuation, as you can see, their valuation is really up there with a PE ratio of 51, dividend yield of 3%. If Digital Realty posts bad earnings and they dip to about like $120 or $115, then I might consider dollar cost averaging. This is a company that I really want to be a part of because I think data centers and cloud storage is the future. And another one is going to be Snowflake. However, Snowflake is still in that growth stage of their life and they're not offering a dividend at this time. However, Snowflake is on the other end of the spectrum and they offer data cloud storage. And other than Digital Realty for Thursday, the next one is going to be Hannon Armstrong, which is in the business of renewable energy, if you're into that. And on Friday, I think the only company that's really important here, please don't say it's going to be PPL or Portland General Electric. Those are both utility companies. This is, of course, in Oregon, and this one is in the east coast of the US and parts of UK. Both of them I'm not really bullish on. However, the company that I am kind of interested in is Treehouse. Treehouse is one of those off-brand store products, right? So if you go to a Walmart before, you're going to have the PepsiCo name brand chips, and then next to it, you have that Walmart brand, right? Treehouse is one of those companies that make those chips for the private distributors like Walmart or Target, etc. Another one of these off-brand food makers is UNFI. However, Treehouse does not pay a dividend, so I am not that interested. So there you have it, folks. Those are the companies that you want to be keeping on your radar for this upcoming earnings week. Let me know what you thought and which companies you are keeping an eye on, and I will talk to you next time. Dividend Compounders with Cheese, signing off. Stay safe, everyone.